Hello and welcome back to Moneycontrol's live stream. You're watching Closing Bell with me, Lovisha, Darad. And we are into the final day of the trading session. And what an action-packed this week has been, given that we had budget on Sunday and then the US-India trade deal, which came out on Tuesday. And finally, today we had the RBI, which kept its policy rates unchanged at about 5.25%. So yes, Nifty indeed has seen quite a bit of a wild ride. But yes, right now this index has seen quite a bit of a recovery from the day's low level. It's back into the green and over 150 points of recovery the benchmark index has seen as of now. So yes, after yesterday's a bit of a loss, we are back in the green and we are pulling above that 25,650 odd levels. Even Sensex has recovered by about 600 points from the day's low. So yes, all in all, markets have attempted a recovery from the last, from 1 o'clock onwards, we have seen that the index have been on an upward trajectory. But yes, this week, we have seen quite a bit of a buying interest which came out in infrastructure players, given that the budget's capex focus and even export-oriented names, be it your textile, shrimp stocks or even auto ancillaries, they even saw frenzy given that the tariffs were lowered on India to about 18% from 50% by the US. But yes, if you look at the broader end of the markets, that looks like a mixed picture as of now. Mid caps have flipped into the green. Small caps continue to see a bit of a loss, but still off the day's low at this point of time with about 0.2% decline. India Wix, if you look at the chart, it's continued to ease, 2% decline coming in from there. And from a sectoral front, it looks like IT stocks continue to bleed for the third consecutive session. If you look at the Nifty IT index, down by about 1.5% as of now. Nifty Auto Index also seeing a cut of about 0.5%. And if you look at the other sectoral indices, be it your pharma or even PSU banking packs, they have also seen a bit of a decline at this point of time. But what has done well and what has stood out in the market today, that is your Nifty FMCG, one of the top sectoral gainers, 2% gains coming in for the index. Nifty Realty also continues to do well, 0.5% gains coming in for there as well. But yes, let's take a quick check of how the gainers and losers look like on the Nifty 50 in just the last 30 minutes of the trade. If you look at the gainers, ITC has done quite well. 5% gains coming in for this FMCG major. Kotak Mahindra Bank also doing well with about 3% gains. Hindustan Unilever, Bharti Airtel on the back of third quarter results has been done well. Bajaj Finance also showcasing a gain of about 1.5%. So yes, about 20 stocks on the Nifty 50 has advanced, while 30 stocks have declined, which has been led by HDFC Life with about 2% cut. On the other hand, Tech Mahindra, TCS, all of them seeing a decline for about 1.5%, given that we have seen quite a bit of a global tech rout. So yes, the Indian IT companies and stocks definitely, particularly, they continue to sulk as of now. But apart from all of these IT names, Asian Paints, Bajaj Auto, Adani Ports, some of the other losers on the Nifty 50 front. But yes, let's quickly move on to our technical expert of the show to understand how the last 30 minutes of the trade looks like and of course how you should be positioned. Joining me is Nilesh Jain of Centrum Broking. Nilesh, definitely Nifty has recovered from the day's low level, and this comes after a slew of policy action and of course rate action that we have seen through this week itself. On the levels front, what are we watching on the Nifty 50 and how does the sentiment look like for next week?
Very good afternoon to Lovisha. Well, absolutely, you have rightly pointed out. We have seen a sharp rebound from the lower levels, and due to that recovery, Nifty is on the verge of breaking out about 25,700 mark. Not only that, it has already reclaimed its 100-day moving average, which is placed around 25,660 levels. So overall, if at all we see this kind of a close where Nifty closing about 25,700, that will be considered as a positive close. And then probably in the coming week, we can expect a follow-up move towards 25,800 and 26,000 as well. Although 25,800 still acting as a strong resistance zone, that's the 50-day moving average resistance for the Nifty. But looking at the overall setup, if Nifty breaks about 25,800, then we are likely to see a short covering rally towards 26,000 to 26,200. At the same time, if Nifty breaks below today's low, that is placed at around 25,500, then we may see a follow-up on the lower side towards 25,300 as well. But overall, looking at the setup, we are likely to witness a very good close and a follow-up move in the coming week that cannot be ruled out towards 25,800 to 26,000. Now, coming to the Bank Nifty, in fact, if you see comparatively, today we have seen some bit of underperformance in the Bank Nifty. But good part is that this has been the fourth consecutive sessions where Bank Nifty is likely to close above 60,000 mark. So that is again a good close we can expect in the Bank Nifty. And on the upside, we can expect a move towards 60,300 to 60,500. Now, if you look at the volatility index in the week, since the major events are out of the way, so IBs are cooling off. A further dip in the IBs will provide more comfort to the bulls. So overall, on the index front, yes, it's a kind of a buy and decline structure. Apart from that, sectors and stock specific action is something that needs to be on the radar.
Okay, all right. That's what the levels are from that front. Of course, Nifty and Bank Nifty index. But yes, let's talk about Nifty IT index. It's been sulking in the trade for the third consecutive session. Of course, we have seen a bit of a global tech rout, and which is why the sentiment has been cautious on majority of the IT stocks. Nilesh, how do you expect this cautious sentiment to prevail over the next week as well?
Absolutely. So, in fact, in this week, we have seen a structural breakdown in the Nifty IT index. It opened with a gap down opening and it has so slipped below its all long-term and short-term moving averages. The long-term 200-day moving average that is currently placed around 36,850 levels. So, till the time that level is not reclaimed, whatever pullback in between will get, that is likely to get sold into. So, overall, we may see a kind of a sell on rise kind of a structure in the Nifty IT space. Not advisable to take any contract at present till the time we get any decisive reversal candle on the chart. But looking at the setup, looks like we may see the levels of 35,000 as well on the Nifty IT index going forward.
Okay, all right. That's the word coming in from the IT stocks. But yes, Nilesh, what about the infrastructure and realty stocks? They've seen quite a bit of a buying interest. Of course, there was an added impetus which came in from the budget where they have highlighted about higher capex spending. So, anything that you're finding attractive from a chart perspective?
See, on technical front, construction related companies like ACE, that is Action Construction Equipment. ACE, this particular counter is looking positive and the setup is looking promising as well on the chart. So ACE, which is currently trading at 918 rupees, has given a fresh breakout today. So we can expect a follow-up move on the upside towards 950 to 980, keeping a stop loss below 895. ACE is something that can be added. And apart from that, NCC, Nagarjuna Construction Company Limited, this particular stock has also witnessed a good pullback. We are witnessing a bullish engulfing candlestick formation as well. So we may see a follow move in NCC as well towards 160 to 165 on the upside, keeping a stop loss below 151. NCC can also be added from a trading perspective.
Okay, all right. That's the word coming in from the realty stocks. But yes, let's move on and talk about defense counters because they have been under pressure. So, throughout this week itself, and of course, this month also, we have seen that Nifty Defense has seen quite a bit of a decline. Nilesh, what are we watching here? And of course, any names that you want to highlight from the defense basket?
See, defense, we have already seen a continuation of a decline in last 3-4 sessions, specifically after budget, we have seen a sharp correction. So at present, there is no trade on the short side. In fact, defense stocks are trading in the oversold territory. There could be possibility of some bit of a pullback move across all defense names like HCL, Mazgaon Dock, Cochin Shipyard, even SCI for the name as well. So overall, defense stocks are currently trading near their respective support levels. So we may see a strong pullback move across all defense stocks, but not recommending any buy or sell at present till the time we get any decisive reversal on the chart. So as of now, one can avoid, but if somebody has already holding the long position, can continue to stay put.
All right, that's the word coming in from the defense basket. And if you look at the Nifty 50 at this point of time, it's at the day's high level, testing above that 25,700 mark at this point of time. So we'll watch out how the just last 10 to 20 minutes of the trade looks like. But yes, let's talk more about individual stock movers of the day. We'll first talk about Nykaa because that stock has done quite well following its third quarter results. Even the street verdict has been quite positive in terms of the brokerages front because we did see Nomura upgrading the counter to buy rating and they have raised the target price given that the operating profit has surpassed the street estimates. What they've highlighted is that they expect the EBITDA CAGR to sustain at about 25% CAGR even after growing at 45% in the past couple of quarters. And even Jefferies has maintained quite a bullish view on the counter. So Nilesh, I mean, definitely the stock is at day's high level, 7% gains, and not just today, but in the past 5 days, the stock has seen quite a bit of a buying interest. In terms of levels, what levels are we watching out next?
So Lovisha, the stock has given a multi-year breakout. If you see, after almost a span of 3.5 years, the stock has broken above its important resistance of 275. So overall, the structure looks positive, and we can expect a follow-up move on the upside towards 295 to 300 kind of levels. But since we have already seen a strong spurt of close to 16% in this week, so not advisable to buy at current level given the unfavorable risk and reward. So better wait for some meaningful decline that can be used as a buying opportunity, keeping a stop loss below 262, and upside is still open up for 295 to 300.
Okay, all right. That's the word coming in for Nykaa. But yes, let's move on and talk about Keynes Technologies because that stock is not done well today. And of course, it's been under significant pressure given that the management has cut its full year revenue guidance. And the cut in guidance comes after the company has missed its estimates across the board during the December quarter because revenue also fell below the management's guidance. Even the margin expansion was not as much as the street was anticipating. Nilesh, the stock definitely at this point of time, it has tried to recover from the day's low level. But yes, I mean, the chart has been relatively quite bearish from the past couple of sessions. What can we expect in terms of sentiment going ahead from here now?
Well, Avisha, if you see majority, in fact, across all EMS stocks, we have seen some kind of a base formation happening. Keynes, Dixon, Ember, in fact, all these three stocks are making an attempt to find and form the base. And this particular pullback, what we have witnessed in the Keynes specifically, this particular counter is hinting that we may see a follow up on the upside towards 3,900 to 4,000. But again, the major structure is still on a weaker side since it is constantly forming a lower top and lower bottom formation. So it is important to take out 4,000 level on the upside to call it as a short-term bottom. But as of now, within this space, the stock that is looking promising is Ember Enterprise. So Ember is something that we are very much bullish on. It has already bottomed out, and we can expect a move towards 7,000 plus. One can keep a stop loss below 6,350, and Ember is something that we are liking within this space.
Okay, Amber Enterprises is something that you're watching out for, right? Definitely, we'll be watching out how the stock behaves in the upcoming sessions. But let's talk more about Hero MotoCorp. The stock has definitely been in the decline throughout the day. It has been in the red, despite the net profit rising by about 12% on a year-on-year basis in the third quarter, while the quarterly revenue also came in at an all-time high. But yes, brokerages have been quite mixed on the counter. Morgan Stanley has stayed overweight, viewing the valuations as attractive. But Jefferies has maintained an outperform rating, saying that the company has seen good growth in the December quarter. Nilesh, what's your view for Hero MotoCorp?
Well, as far as Hero MotoCorp is concerned, it has already given a good breakout from a falling channel from the levels of 5,700. Now it is, kind of retesting those breakouts. So we may see some bit of consolidation, but the undertone is still on a positive side. We can expect a gradual up move to continue towards 6,000 to 6,300 on the upside. So one can keep a stop loss below 5,550, and if you get any dip towards 5,700, 5,650, that can be a good entry point. The structure from a positional perspective is still on a positive side.
Stay on the positive side. That's the view for Hero MotoCorp. But yes, let's move on and talk about another stock in focus today. That's your NCC. Given that the stock has recovered from the day's low level, right now the stock is with about 2% gains, but at about 155 odd levels. But the management did decline to provide a qualitative guidance for the second half of FY26 because of some execution headwinds. If you look at the December quarter numbers also, that also doesn't speak quite well for the company. Profit declined by about 36% on a year-on-year basis. Revenue was down by about 9%. EBITDA also declined by a percent. Nilesh, for NCC, of course, it's a negative set of results, and that's why the stock did see a little bit of a negative reaction. But right now, the stock is recovered from the day's low level. What's your assessment?
Looking at the recovery, it's kind of a good recovery. I would say it is closing on a positive note. It is forming a bullish engulfing pattern as well. So, as mentioned, we are bullish on the construction space as a whole, as well as infra space as well. So, NCC, yes, we can expect a follow-up on the upside towards 160 to 165. One can keep a stop loss below 149. And yes, if somebody is already holding the long position, can stay put.
Okay, all right. Anyone holding a long position can stay put for NCC. That's the key takeaway. But yes, with that, let's move on to our next stock in focus. It's one of the top buzzers today. That's your Hitachi Energy. It's quite a spectacular run that the stock has seen, given that the company did say that it has maintained its double-digit operational EBITDA guidance for the next financial year. Even for the third quarter, the company has reported quite a spectacular set of results. Margins increased by about 600 basis points in the year-ago period, while this is the second consecutive quarter of mid-teen margins. And even profit perspective, 90% gains on a 90% growth on a Y-on-Y perspective. And of course, revenue was also up by about 28%. Brokerages have given out a buy bullish call on the counter, which is why we have seen that the stock has done quite well today. Nilesh, the stock has definitely seen a good breakout today, but do you believe that the gains can sustain from here on?
Well, absolutely. Very strong breakout with a gap up opening today. In fact, the counter has surpassed all its key short-term and long-term moving averages as well. So from here, we can expect a fresh record high towards 22,300 to 22,500 on the upside. So structure still looks strong, and we can expect a follow-up move to continue. But since it's already up close to 13% today, so not advisable to buy at present level because the risk and reward is not favorable. But yes, buy and decline should be the strategy. It has a very good support at 20,500 kind of levels. So buy and decline should be the strategy.
All right, buy and decline is the strategy for Hitachi Energy, and of course, strong set of charts. That's what Nilesh has been talking about. But yes, let's move on and talk about Cipla. The stock has been down today, given that GST has initiated inspection and search proceedings at certain facilities of the company, but the company has stated out that the inspection or the search has no financial impact on the company, and they have been cooperating and assisting through the authorities. Nilesh, the stock anyway has been under pressure for quite some time. Do you expect the sentiment to remain negative going forward?
Well, as of now, there are no clear signs of a trend reversal. The counter remain under pressure since a long time. Whatever pullback we have seen is getting sold into, and we are witnessing sort of a consolidation, you can say, in this particular counter. Although it has found a very strong support at 1300 kind of level. So keeping that as a stop loss, one can remain long. But if it breaks below 1300, then we can expect a further slide towards 1250 as well. But yes, pullback is something that one can expect towards 1360 to 1400 on the upside.
Okay, all right. That's the view for Cipla. Right now, the stock is seeing a little bit of a negative reaction, so to say. But yes, let's move on and talk about LIC. Definitely, the stock is sustained throughout the day with about 7% gains, given that it did report a good set of third quarter performance. If you look at the net profit, up by about 17%, net premium income jumped by about 17% on a year-on-year basis, and brokerages have remained quite positive. JM Financial has called the results as very strong, which was led by individual AP growth of 61%, and which is why they have raised its FY27 to 28 estimates for APEs also. But yes, Nilesh, for LIC, of course, the stock has done quite spectacular today, and even for this month, they've started quite strongly. So, what's the next resistance level we can watch out from here on?
Well, Lovisha, absolutely a very strong set of number, and we are also witnessing a reaction on the price action as well. A very good price and volume breakout can be seen in this particular counter. And even if you see on derivative front, we have seen huge amount of spurt in the OI addition that is close to 11%. So strong long buildup is also happening. The counter has surpassed its important 200-day moving average, which was placed at 875. So looking at the overall setup, we expect momentum to continue towards 950 to 980 on the upside, and stop loss can be placed at 865. Buy and decline, buy at current level can be the strategy, but positionally we expect this counter to gradually move towards 1000 plus. So looks good on the chart, short term as well as from a positional perspective.
Okay, all right. That's the view for LIC. Looks good from a short-term perspective, and we'll watch out how the stock reacts in the upcoming days. But yes, let's talk about Godrej Properties. The stock is up by about 0.4%, but it has relatively cooled off from the day's high level. But still, the stock has been marginally higher. Now, this comes after the company has reported about 23% increase in its net profit. Total income, however, declined by about 16% on a year-on-year basis. Nilesh, what would you suggest investors to do? I mean, of course, Godrej Properties doing quite well, and given that it has seen quite a bit of a sharp underperformance last month. So what's your take?
Realty space has been under pressure since the past few months now, I would say, where we have seen a continuation of a formation of a lower top and lower bottom. And as far as Godrej Properties is concerned, if you see last 1.5 years, the counter has constantly underperformed. and it is currently trading below its all long-term and short-term moving averages as well. But since it has gone into extremely oversold territory, there could be possibility of a pullback move towards 1800 to 1900 on the upside. So yes, pullback can be played keeping a stop loss below 1600, and a momentum can be seen towards 1800 to 1900.
Okay, 1800 to 1900 could be the next resistance areas. All right, let's move on and talk about BEML because the stock has been trading at the day's low level, 7% slide where the company has reported. Given that the company has reported a net loss during the December quarter, which is why the street has turned quite cautious. But the top line has seen about double-digit growth, 23% Y-on-Y increase. But EBITDA has been nearly wiped out during the quarter. But yes, a weak set of performance, Nilesh, for BML, and which is why we have seen there's a sharp breakdown on the counter. What's your assessment?
Absolutely. There is a clear, sharp breakdown can be seen on the chart for BEML. Even if we see volume, today's volume is higher than the average volume. So price and volume breakdown, you can say, although we may see some bit of a pullback since we have seen a sharp reaction after the numbers close to 7% correction. Yes, that's the reason we may see some bit of a pullback, but that pullback is likely to get sold into. Structure appears weak for 1550 to 1500 levels on the lower side. So again, not advisable to take any counterbet in this particular counter. It's an avoid.
All right, it's an avoid for BEML. But yes, let's talk about one of the top Nifty gainers today before we get to the close. That's your ITC. That stock has definitely done well. And of course, given that we have seen, the sharp underperformance last month, it seems like investors have digested the news of taxation on tobacco taxes. Nilesh, what's your thoughts on ITC? We're definitely one of the top Nifty gainers today.
Absolutely. So, first of all, we are bullish on Nifty FMCG space. We have seen a strong rebound in the Nifty FMCG index itself. So, we are likely to see a pullback move to continue in the FMCG and consumption space. That is something that we are bullish on. Again, coming to ITC, yes, you have rightly pointed out, we have seen a very good spurt in this particular counter. And we have seen some bit of a rebound on the indicators front as well, where MACD has given a fresh buy crossover as well. So, we may see a follow-up move on the upside towards 340 because if you see in the month of December and January, we have seen a sharp decline all the way from 400 to 300. That correction was almost kind of a 30% correction we have seen in this particular counter in a very short-term time frame. So, given this kind of a setup, there could be possibility of a relief rally that we have seen today. A follow-up move can be seen in the coming session towards 340 to 350. One can keep a stop loss below 315, and yes, it's a buy at current level and on decline as well.
Okay, all right. That's the word coming in for ITC. But yes, let's address the last rates which is coming on your screen. Nifty is up by about 31 points. It's back above in the green with about 25,650 odd levels. Even Sensex has done quite well. 200 points of gains. That's where we are settled at this point of time. And of course, Nifty has snapped its two-day losing streak also at this point of time, given that it has edged back into the positive territory. But yes, it's about 150 points recovery that is coming in for the benchmark index, and Sensex has also recovered by about 600 points from the day's low at this point. If you look at the broader end of the markets, however, if you look at the Nifty mid-cap index, it's up by it's still settled in the red with about 0.1% loss. Small caps also seeing a decline for about 0.3%, and even throughout this week, we have seen that the Nifty small cap index has been under relative quiet pressure. India Wix continues to cool off, 1% decline coming in from there. And from a sectoral perspective, it's the Nifty FMCG which has been leading the way. Like we were discussing with Nilesh also about Nifty FMCG, that has done quite well today, 2% gains coming in for the index. But yes, the loss and of course the big sulker of the day continues to be the IT stocks. Nifty IT index settling in the red. Third consecutive day of losses on the back of the AI-led fears, which has crippled the index and of course majority of the technology names. Apart from that, if you can see, Nifty Realty Index has ended in the red, in the green, 0.6% gains coming in for there. Nifty PSU banks have also, settled in the red with about 0.5% decline coming in from there. Nifty Metal Index with about 0.1% decline. So yes, all in all, it's been a mixed picture from a sectoral perspective, but still we have managed to end in the green on the last day of the trading session. But yes, we'll get back to Nilesh on his top picks. Nilesh, now that the budget is done, the US trade deal is out. I mean, in terms of your top picks, what are you watching out from a technical perspective?
Right, Lavisha. So we are focusing on the long only ideas because given the major events are out of the way, so the focus should be on the quality stocks which are available at a corrected price. So first of all, we have already mentioned about the EMS space, specifically Ember Enterprise is something that we are keeping an eye on, and we have also recommended to our client as well. So we are expecting a pullback move towards 7,000 plus kind of level in this particular counter. One can keep a stop loss below 6,300 and it's a buy. Another stock that is Pidilite Industries, where we have seen a very good rebound. The stock, in fact, is on the verge of a major breakout from a falling trend line. So we are expecting and preempting that this counter is likely to break the hurdle of 1500 going forward and move towards 1540 to 1560. So one can go long in Pidilite Industries at current market price, keeping a stop loss below 1455. So this particular counter is also looking positive. Coming to the two-wheeler space, TVS Motor is something that is looking positive on the chart, given the kind of rebound that we have seen today. It has formed a bullish engulfing candlestick formation as well. So we may see a follow-up move on the upside towards 3850 to 3900. One can keep a stop loss below 3650, and TVS Motor will be another stock that one can go long.
Okay, it's the consumption names that you have highlighted so far. All right, on that note, we have to let you go, Nilesh, but thank you so much for your time and joining us.
Thank you, Lovisha.
All right, we have finally seen that the Nifty 50 index has settled in the green, and it's the second consecutive week where the Nifty 50 has ended in the green. So yes, for the week itself, Nifty is up by about 1%, Sensex also up by about 1%. From a sectoral perspective, Nifty Auto Index has gained by about 2.5%, and one of the top sectoral gainers has been the Nifty Infrastructure Index, which has gained by about 4% on the back of the higher allocation which was done in the budget. Nifty Metals has also done quite well, but yes, the sectoral laggard of this week has been the Nifty IT Index, down by about 6% so far this week. Other than that, you can see Nifty PSU Banks is also, for this week, it has been one of the top sectoral laggards, but oil and gas, Nifty Realty Index, all of these sectors have remained quite buoyant and quite resilient for so far this week itself. But yes, to talk about markets and where it is headed, let's quickly get on board with Shridatta, who is the CIO Equities at Canara, Robeco, AMC. Shridatta, good afternoon. So good to have you here. It's our first conversation. But plenty of things have happened this week. We have had the budget, US-India trade deal, and now the RBI keeping a status quo policy. How are you assessing the markets now and from a 6-month perspective?
First of all, good evening. As you said, this is the first interaction. Thank you for having us on the show. At all point in time, you actually enumerated some of the issues. There are issues in and around macro and micro, and we keep debating this. At this point in time, how we are looking at it is to step back and think about it as to what has happened over last roughly 3 or 4 quarters, and what are the factors which have led to the situation in which we are. And when you think about it, there are 2 aspects that have happened. On the top of macro side, you clearly had one, tariff-related worries, and second, a globe which geopolitically also was a little more challenged last year. On the other hand, domestically, you had very, very high expectations to start with, where the valuations were little out of whack. There was a lot of exuberance, and the earnings did not play out. So combination of a macro, which particularly the global macro, which turned little negative, as well as the earnings valuation context, which was fairly aggressive to start with, that has led to a situation where we are. But as you actually look at it today, we have actually gone through almost 15 to 16 months without any returns. The earnings have gradually started getting back on its basically feet. And just to put it in numbers, last 6 quarters, we had roughly mid-single digit earnings growth for large caps, and small caps were negative roughly, and mid caps were probably double-digit earnings growth. Gradually, that earnings growth has started actually going up from where it is. It doesn't mean that the earnings are going to grow at a very rapid pace, but at least they're coming out of a trough. At the same time, since for 15 months, nothing has happened. The valuation gradually is moderating from where it was, because the earnings have at least to some degree been growing. And so that's the context in which we are. Today, the market and the screen and the factors, except the latest trade deal, look a lot more negative. But gradually, we are getting more and more constructive, because the factors which led to the situation in which we are today are gradually reversing. The earnings are gradually reversing. The valuations are no more that exuberant. The FIIs have been selling. So again, there is a lot of pressure on the liquidity side. Uh, Domestic supply has been very strong. RBI policies, both in terms of interest rate and the credit growth that has been panning out, is good. So most of the factors which led to earnings slowing down has recovered. And so uh, when I actually look at from next 12 to 18 months from today, it looks like a far more constructive market as compared to where it was 6, 8 months or a year back.
Okay, got it. Shridatta, what does it mean in terms of global fund allocations? Because we have seen since January last year, the emerging market funds have seen quite a bit of an inflows, but India has remained quite underweight. Do you expect in terms of earnings, like you were talking about, that the last 6 quarters has seen a muted single-digit growth? Going ahead, we could be, seeing a better perspective in terms of earnings growth. How does it make sense, in terms of the allocations where we are at in terms of India?
I think clearly one is, as you said, where are we in terms of allocations? Now we are underallocated in most of the global funds as well as emerging market funds. But the factors have been the same. The factors have been why global investors have ignored India, despite they going to some of the emerging markets and not all emerging markets, is predominantly to do with our underlying valuation earnings context, which was there 12 months back or 15 months back, which was really adverse as compared to a lot of other emerging markets where the earnings growth was 10-12%, and the valuations were far cheaper than India. Having said that, there is also another factor which has impacted the flows in India. India is only large probably market, at least among where the flows have been very strong, where there have been no AI related or technology related plays, and to that extent, the capital flows have been towards US, towards some of the European countries, as well as large geographies like Korea, Taiwan on the emerging market side, or otherwise cheaper markets like Brazil. And that's where a combination of two things: the starting high valuations, then the disappointment in earnings in India, as well as the AI plays, technology plays, which are high growth plays in the context of the valuations in those particular markets being available there. I think those two factors have led to the FI outflow, but I don't think that's a permanent situation. FI Any investor, whether it is local or global, as far as institutional investors are concerned, they always look at the earnings valuation context and then they decide to allocate. Today, that context, or for last 12 months, that context was not looking good for India, so they did not allocate. But if, for example, if what we have seen in some of the uh, uh, tech stocks in US lately, uh, uh, or what has happened in precious metals lately in terms of volatility, if there were to be basically correction on that side, then India might again look little better, given that our earnings and valuation context is also gradually coming in place. So that's how we read it. But technically, they are sizably underweight India as far as FIs are concerned. So if our earnings were to turn, they will come back.
Okay, got it. But Shridatta, does it mean that finally in FY27, India can see double-digit earnings growth? What's your assessment?
As of now, when we look at the consensus number, clearly that's the case, that you are looking at earnings growth moving up from single digit in financial year 26 to mid double digit. So the consensus is anywhere between 14 to 16% earnings growth for financial year 27. And I think that's this year it looks like it is achievable, given that predominant part of that incremental earnings is coming from some of the sectors which have been really beaten down or delivered a low earnings growth last year, including the financials, large financials.
Okay, got it. Shridatta, let's talk about sector specific. We'll talk first about Indian IT companies, because we've seen quite a bit of a global tech rout, and because of that, even Indian IT companies have succumbed to the selling pressure. But what does the near term and of course the long term implications mean on the back of this entire AI related fears which is going on in the markets? I mean, since we've already been quite late to this entire AI race, can we see a revenue impact going ahead?
IT services companies, yes, clearly, but the pace at which it is happening, did we or anybody anticipated that? Clearly, no. Does the news flow that is going around in the market really mean that the impact of some of these new AI related stuff is going to be as much as people are quoting in market? I think again, it's a lot of it is speculation. Nobody knows, frankly, as to how fast and to what degree the impact is going to be there. Yes, for sure, one thing is likely to happen, which is that a lot of these are productivity tools. Also, effectively, if they increase the productivity of individual, then you don't need so many individuals. And a lot of IT services verticals for Indian IT companies were built on cost plus model and hourly basis model, whereby you are using labor arbitrage, you are using the effective labor on an hourly basis effectively to charge to your customer. That for sure is going to get impacted. But will the impact be the same to the degree that has been discussed this week, particularly after the Anthropic announcement? Nobody's sure about it. There is a lot of debate, and so jury is still out. That there are equal amount of there is equal amount of logic that is being given on both sides in terms of how quickly it is going to impact. But in medium term, yes, for sure, it is likely to impact whatever 10, 20, 30%, depending on the company that we were speaking about in IT services in terms of their revenues. And so they have to be kind of, in a way, compensate that and then grow. And on top of that, the industry is mature, and that's where a lot of this question mark in terms of the growth, future growth of this sector.
Okay, got it. So, would you advise that investors should turn selective on this sector, because earlier they were seeing it as a cheap story, in terms of entire sectoral perspective. It was the IT which was trading at comfortable valuations. But we still have growth visibility which is yet to get proven, because even in the third quarter, the top line growth has been quite muted. So, would you advise investors to turn a little bit of caution, at least selective in this entire sector?
I think it merits to be selective across the market. It is not true only about IT, it is true about every sector. But specifically, given that this is a little more mature sector in terms of growth profile and there is a technology disruption risk, yes, what you're saying, people should pay heed to that. People should do their due diligence before actually broad basing their view in terms of how a particular sector is likely to do. And IT, while optically it is not that expensive, it is not cheap. Because roughly, if I take the top 5-7 companies, they are trading at roughly still 20 times 1.5 year forward earnings, which is not necessarily cheap for the earnings growth that is projected for most of those companies. But there was a hope that there is likely to be a recovery of earnings in financial year 27 in IT, and that's where some of the commentators were saying that it is cheap. But if the technology risk in terms of revenue disruptions were to play out ahead of actually recovery in the general macro recovery in the client side, then you might not see the outcomes in number, and then they don't look necessarily cheap.
Okay, got it. Shridatta, you said that you're watching out for double-digit earnings growth in FY27. Do you finally see small caps participating in this?
It's very difficult to say that, but one thing is for sure that at least the expectation that was built in small caps 1.5 years back, probably 60, 70, 80% of that is gone. So there is no exuberance left in terms of how people were building in earnings, and on top of that, how people were building in multiples, because ultimately stock outcomes over a period of time is a function of earnings and re-rating or de-rating. I think fair amount of de-rating has happened. But when I look at the aggregate numbers, and you should never go by the aggregates, but because when we actually look at our portfolios, we always go bottom up, say, stock specific. But at aggregate basis, large caps from a valuation perspective still look good. Mid caps are expensive as compared to their historical valuations, but the earnings have actually relatively hold on very, very well in that space. Small caps for last 4, 5, 6 quarters, the earnings have been really disappointing. Barring this quarter and last quarter, the earnings have gradually started recovering. The valuations have also recovered. So anybody who has a interest in broader market, I think should look at a little longer horizon, should be ready for more volatility or consolidation, and should have basically the return expectation which should be more in line with long-term averages rather than what people experienced in calendar year 22 to 24.
Okay, got it. But everyone has been chasing the growth story, especially from the small cap space itself. So, I mean, would it take another 2-3 quarters to actually make them finally go back there, or should they start accumulating at these current levels?
I think long-term investors, basis their asset allocation and basis advice from their advisors, there is no harm in allocating to any category as long as they have understood the volatility risk part of the broader market and have a horizon. But clearly, I think people need to have a longer horizon as far as the broader market is concerned, despite last 15 months of basically sideways market.
Okay, got it. Shridatta, I mean, with the trade deal out, are you comfortable revisiting the export-oriented plays, textile, auto ancillaries for that matter?
So first of all, I mean, we are not actually completely kind of taking that call that the trade deal is done. At least on paper it is done, not on paper, but at least in the conversation it is done. You need to see it in paper. That is one. So you have to wait for that. Second, don't necessarily allocate or reallocate money basis the trade deal, because first of all, if you look back our conversation or any conversation, the trade deal had a more negative sentiment impact from market perspective rather than just numbers, because in numbers half of our exports were actually excluded from the tariffs. So the tariff impact was predominantly in 2 or 3 sectors, probably textile, gems and jewelry, and some of the other smaller sectors. Within that, I think textile is one investable sector which clearly could be beneficiary. But again, there are very few opportunities in that space, very few large companies in that space. But with the EU deal done, and if the US deal actually gets done in terms of as it has been quoted, then clearly probably some of those spaces will benefit. But there is a limited allocation that we have in those spaces. We are not thinking about changing. Auto ancillary, as far as my understanding goes, they were out of the tariff. So that is more business as usual, nothing to do with tariffs as far as the Indian companies are concerned.
Okay, got it. Shridatta, in terms of sectors, what are you finding, in terms of growth visibility, anything that you're finding comfortable at these valuations?
I think, so there are two parts to the market. There are certain sectors where either the expectations are low or the expectations and valuations both are reasonable, which is probably some parts of consumption as well as some parts of financials. These are the two spaces I'll put in that bucket, where the expectations, earnings, both are fairly benign. That's one space where we are constructive on. And then there is a second space where the earnings are actually present. They statistically are a little expensive, but we have a lot of growth visibility there. They are capital efficient businesses. So segments like auto ancillary, part of consumer discretionary basket, some of the capital market plays, you have consumer tech companies, which is your quick commerce and otherwise. Then you have basically some of the industrials like cables, transmission, defense, where the earnings visibility again is fairly high. Plays on data center where the visibility is again high. So it's a combination of sectors where either the expectations on earnings as well as valuations is reasonable, which is financials and say FMCG and other sectors. And then there is a space which is growth space where the growth visibility is very good. And then there are smaller sectors like aviation, telecom, hotels, where we are actually hospitality, where we are constructive on.
Okay, got it. Just one last question before I let you go, Shridatta. I mean, SEBI, recently today itself, they've tightened some margin rules for single stock spreads on expiry day, and we've seen capital market stocks seeing quite a bit of an impact. I mean, do you see any impact on trading volumes on the back of this news flow?
There will be intermittent actually impacts of some of these events, and I think rightly so said that the regulator has been and all the regulators have been actually moving towards curbing the speculations whereby retail people are losing money, and that statistics is out. I think 9 out of 10 customers are net losing money there in those segments, and to that extent reducing that volatility is only going to help. Will it impact some of these companies in near term? Yes, for sure it will have marginal impact depending on the extent of tightening. But over a period of time, if you look at the where the savings pool is moving in India, I think savings pool is moving towards the investment part of the economy versus the bank FD part of the economy. And so time to time, some of these opportunities will become attractive from medium-term perspective. That's how we read it. We look at it more as a play on savings in India, as against how in households used to play savings in the past, rather than actually looking at it from really near term.
Okay, got it, got it. All right, Shridatta, lovely conversation, but with that we have to let you go. But thank you so much for your time and joining us.
Thank you so much for having us. Thank you.
All right, with that we have come to an end of this edition of Closing Bell. But remember that the markets have done quite well for the second consecutive week, and today also that Nifty has settled above that 600 mark, so to say. So yes, quite a bit of a good start for this week after the budget day, and of course the India-US trade deal has definitely reignited some good participation from the investors. We'll watch out how the next week pans out for the markets, but until then, do stay tuned to Money Control. We'll be back with markets next week, and thank you so much for watching.